Okay, welcome everybody. This is my second recording because my last one failed. So hopefully I'll be a little bit better second time around. I don't know, maybe I need the three times the charm situation. But anyway, we're looking at the S&P 500. Um, the market resumed its path higher today, this week, although uh, less dramatically. It seems to be slowing. Um, we had talked about. I can't get all that in there. Let me zoom back out and zoom differently here. So we had talked about one of the things that I was seeing is that you had this big thrust up, and then you had a pullback, and then you had another big thrust up, and then you had a pullback, and then the trend seemed to be that this one is big. This one's maybe 2/3 the size of this one, and this one was likely to be 2/3 the size of this one. I still think that's true, although true is not the right word. I still think that's probable. But what I would say about that is it depends on how the market pulls back. So, for example, or if it pulls back at all. I would say if the market doesn't continue, if it doesn't pull back and it just continues to do this, then this three decreasing thrust scenario is likely, and that we're probably going to get a pullback at least into there and maybe all the way back to reverse the whole pattern. But if the market, let's say the market instead pulls back just a little bit, like so, let's say it just pulls back to there and starts to turn up, then I think you could see this market come up here into this 2250 area or 2300 even. So I don't have a care one way or the other. It makes no difference to me. But I would say if it continues to drift up, but the internals continue to be soft. So one of the things that you can look at in the market is there's what's called advanced decline. So as the market moves up, are advancers increasing faster than decliners? As the market moves down, so are advancers still, the number's still good on advancers? So you look for these internal measures. There's also sentiment. So at these extremes, you'll see sentiment. Like if this were an extreme, this yellow area, and sentiment was 95% bulls, then you're close to a turn, okay? But right now we're like 50 or 60% bulls, so we're not really close to a turn, but it's also not advancing very rapidly, and the internals are very soft. So you've kind of got, it seems like the market is running out of gas in a different way than it normally does. I mean, it normally you have this aggressive move from bearishness to bullishness normally in the market. So when the market moves, for example, when the market moved, say, from here to here, you might have had, I don't know, only 8%, 7 or 8% bulls here. So the bullishness was really low, right at the bottom. See, that's the key. It's at the bottom. So this is likely a good place for a turn. And then in this span of time, right here, you had 90+% bulls. That tells us there's going to be a pullback. So in the advanced decline line and all that stuff increased just like it's supposed to here. Here you've got the bullishness here was low. It was like 7-8%. But and I would say even here it was probably 50% bulls, 60% bulls. But the advanced decline numbers were really high. What you've got here is you've got a 50 or 60% bull rating, but the advanced decline numbers are very low. So that tells me that there's some diminishing fervor in the market. And like I said, you could just get this could just squiggle up a little higher to get to a new high and then rapidly drop off. So there's no way to know that, but certainly with these internal numbers, there's something going on in the market that wasn't going on right here or even right in here. So it's just something to be aware of. Let's look at the VIX real quick. The VIX remains low. So there's a lot of complacency in the market. I mean, there's a feeling like, well, the bull market's been going a long time. It'll probably continue. And maybe that's true. I don't know. But it seems to be kind of holding a trend line barely here. But then what you notice is that, it's trending upward here too. So we do have higher highs and higher lows at these extremes. Normally we don't put a lot of emphasis on the trend for volatility, but and I wouldn't here either. It's just something I'm pointing out. I wouldn't put a lot of weight on that. Treasury yields. Last week we talked about the fact that the Fed would likely be raising rates because now we were trading above this 0.035 area, which was resistance for a long time. I mean, you can see how it would bump up against it, fall down, bump up against it, fall down, bump up against it, fall down, and boom, during the election, we busted out of it. Now we've pulled back, and this was a pretty strong move. So, you have a strong couple of weeks up, and you got a strong week down. So this might go a little lower next week, but I think the trend in interest rates has likely changed. There's no way to know for sure, but if you just look at even if you just look at this short-term interest rate over a longer period of time, you can see it was just very, very flat, almost like there was, the Fed, there was like a floor underneath it. Zero was underneath it. So, but we've clearly come off of zero, and we ran up, we consolidated, we made another run up. So one of the tenets of technical analysis is old resistance. So this would be old resistance. It was resistance all throughout here. Okay. So old resistance becomes new support. So as the market pulls back, does like that. So this line now becomes support in the market. Now, it doesn't become support like it can't be violated or that's some sort of rule. It's just, it's a technical analysis kind of tenet. It's something that is more likely to be than not to be. So when I make these statements, don't act like that it can't do something because I said this is support or this is resistance. That's not the case. It very much can do that. It's just the probability, the likelihood of it doing that is lower than it is of not doing it. So anyway, we can also look at the 10-year Treasury. Had a good week, gapped up, ran up after a really strong week last week. Same thing with the 30-year Treasury. So you got yields moving higher. Likely going to be some announcement from the Fed early in December about raising rates. So be on the lookout for that. And that could coincide. The interesting thing could happen is you've had a run up in rates. Sometimes what will happen is the Fed will announce a raise. Let me just go back to the short-term chart or the short-term Treasury real quick. So let's say the Fed announces a rate hike. When is that? A couple weeks from now. So let's say, this comes down a little lower, but then starts to kind of go this way, and we're right here, and the Fed now announces a rate hike. Well, the first thing that's going to happen is that probably this goes down. Okay. and maybe chops around down here along this support area and then starts to take off. But a lot of times what will happen is once the news is out, the market will sell off because there are people there that want to take some profits or whatever. So that'll happen. So a lot of times that'll happen. The market will sell off, and well, that's weird. The Fed raised rates and then interest rates went down. Well, that's just because there's some people that are, now that the news is out, they want to take their profits and move on. So just be aware of that. Sometimes that confounds, the business media. They'll go, well, that's weird. The Fed raised rates and the rates fell. And you're like, well, yeah, but that's because there are traders or real people out there, trying to protect their money. So that's what's going on there. Well, let's look at a couple of these countries. Germany, I think, is probably the most important to look at just because it is the powerhouse within Europe. And as Germany goes, so does, France, Spain, Italy. And you could have a situation where Spain and Italy, for example, are dragging Germany down. But clearly, this, and I've had this channel on here for a very long time. It never ceases to amaze me how you could have something drawn on here, and lo and behold, the market respects it as if it knows that you drew it and is holding that line. But I would say Germany at least pull down here to the midline, bounce a little bit, and then resume lower. So anyway, Germany I think is important to look at because it's kind of the powerhouse of Europe. United Kingdom, now that it's out of Europe, or will be out of Europe, well, or may not be. I mean, it seems like the political class is trying to overturn the whole Brexit thing and say, well, it wasn't voted on by the representatives, and I mean, who knows what's going to happen there? But you could draw a larger channel here. Like if I drew a channel more like this, you could say that Great Britain is respecting the channel. I don't know. It's not as good as Germany in terms of respecting the channel, but there's nothing here that I see that would indicate to me that Great Britain is looking particularly bullish, although you do have some higher lows and higher highs here. So, you've got kind of an uptrend for the time being. This could be more of a triangle, that's kind of tracing out, and which could be bullish. I mean, this could be the first move, and then this triangle is a consolidation, and then maybe somewhere along in here you get a breakout up to there. So potentially that's bullish, but right now it still looks very bearish to me. And since Germany is kind of the industrial might there in that Eurozone, and that looks clearly bearish, I would be very skeptical about the UK. All right, let's just go look at the US dollar real quick. So we've had, let me scoot this down a little bit. We've had this resistance zone drawn on here for a long time, and it looks like the dollar is well on its way to hitting that. But it has broken out. You can see here that it broke out of these previous highs, and many times when something breaks out, you get a little bit more run up, and then you get some sort of retest to the breakout, and then it goes higher. So the reason I bring this up, if you go look at, let's go look at the euro US dollar. It's hard to get this all on the screen because it's so low on the chart, but it's had a big run. I mean, this was that what happened is during the election, when the market sold off, the euro ran way up and then turned around and sold back off and then ran all the way down here. So it went from like, 113 all the way to like 105 in what is that, 2-week period. So, if this is the lower trend line, I think over the next couple of weeks you could see the euro kind of retest this and then come down to our support area. So if you're wanting to get short in the euro, I would wait a little bit and wait till it retests this area and then get short the euro and make some money. If you look at the British pound yen, I mean, this thing has been moving dramatically. I mean, this move in 2008 was huge, but this move in 2016 has also been very quite large. So you get huge rebalancing going on in the currency flows. Money flowing out of some countries. Basically, to me, what it looks like money's flowing out of every country, but flowing into the United States. That's kind of what I see. If you look at the euro JPY, it's just got money flowing out of the euro and into Japan. But if you look at the dollar JPY, you can see that money's flowing into the U.S. dollar and out of the JPY. So just there's a lot of this has to do with speculation around trade balances and things like that, future trade balances, trade wars. I mean, who knows what this is all about. But suffice it to say, there's money moving around the world from some places that money doesn't want to be to other places that money wants to be. So that's going to have huge impact on financial markets. All right, here's a big picture of oil. We got this zone way down here, but really what's happening is right now is up here. So what I see here is oil, unlike the currency markets, is more in the middle of these two areas, and you've got kind of a trend line here, and it's respecting that, and it actually touched it and just blew right off the bottom of that. So last week I was saying that oil was likely to come down here and test this support area, maybe run up, maybe continue down. But you could take a position one way or the other here without taking a lot of risk and be wrong small. Now we got a situation where it's turned kind of in the middle here. So it could be that oil is going to actually run up here first. And one of the things I noticed I didn't notice before is there's a gap right here. So it could go fill that gap and then run down, start running down to like here and then lower. So right now it's in the middle. I wouldn't take a position in oil unless it was either down here or up here. So if it starts to move up here, wait till it fills the gap, take a position short, or wait till it comes down here to take a position long. That's kind of what I would do. I mean, you do what you want to do, but that's what I see. All right, let's look at gold real quick. Gold and silver both, same kind of scenario that oil, just a little closer to the support areas. If you're going to take a position long in gold, it might not, one of the things I need to say about these areas, these are zones, these are very arbitrary. So you could have gold just pull down to here and not actually touch this area, and then maybe the following week start to see it move out. That's certainly possible. I mean, there's nothing magic about where I've drawn these zones. It's only where my eyes see pivots and things like that. So don't put too much emphasis on where I have these drawn. I've told you before how I draw them. I go to the most recent pivot area, like right here, and I simply draw a box just below it. So this box might be a little bit too far below it, and gold, if the box were a little higher, gold would touch this at a little bit higher price. But certainly what I'm expecting to happen is gold to move down into this area and then bounce, likely to a higher high, maybe just above this 1388 area. And that would take months probably, for that to happen, for it to come down and bounce up to there. So we've got maybe a multi-month run in gold setting up. So if you're interested in taking a position in gold, you might keep an eye on that. Well, that is about it for this week in the middle class investor. I would continue to watch the S&P 500. Now the Dow, incidentally, the Dow is at new highs, and if we look at let's look at like a 20-day on the Dow, you can really see how the Dow. So remember I talked about how it came off this bottom, and the bullishness was very low here, so it came off the bottom pretty strong. But through in here, the advanced decline line, the advanced declines in the market were not really that big, and so you've got this, this really waning kind of action in the Dow and really in the S&P too. But so it's really hard to say. You can really see it here where it ran up, it bounced right where it should, right when the bullishness is super low. I mean, bullishness was super low all through here, really. Maybe 15% here, and then finally it fell to like 7 or 8 and then bounced. But then the advanced decline the internals weren't very strong, and so then it kind of faded into this. So, again, if it pulls back, say to here, kind of controlled, and then starts to bounce, we could get, it could go 300 or 400 points higher. Or if it falls here and falls right through this low and continues, let's go to a daily. If it falls and it falls right through this low and continues, that could be a more substantial top taking place, and we wouldn't be making any new highs up to the top of this channel that you see drawn here. So from a probability standpoint, it's likely that the Dow moves to the top of this channel. I mean, it could, next week we could get a sharp little pullback to like right there, and then a pretty strong run, right into that, and maybe even overthrow it a little bit into this 19.5 area. And then we get a pretty sharp pullback, but or it could just fade right from here. I mean, it's really hard to say, but this is a very weak action that's happening right in here, right in this area, and I wouldn't be surprised if it surprises everybody. But I'd say one caveat to that is the fact that the S&P hasn't made its higher high yet. Well, it has on the SPY, but if you go to the S&P 500 index, you can see that we're below these highs still, these highs from back here. That's interesting. I didn't know that the SPY was actually higher. So the SPY has actually made a new high, but the SPX, the index, has not. So that's unusual too. Anyway, it's just the internals are just kind of weak. That's the only thing that has me thinking we might not see the top of this trend line here. Is it's just the internals just aren't strong enough to really launch the market up there. I could be wrong, but that's when I see those weak internals, my spidey senses kind of flare up, and I start to look at other possibilities. All right, everybody, that is it for this week. Thank you for coming in, and hope to see you next week. And as always, if you have any comments, you can comment on the YouTube channel, or you can go to Middle Class Investor on Twitter, which is at the @InvestorClass, and comment there. I look at that. I'm not a religious Twitter person, but I do look at it, and will respond if you if you have comments. Okay? Thanks, everybody. Appreciate you coming in, and happy Thanksgiving, and hope to see you next time. Bye-bye.